Do you want to make huge profits from trading options? You have seen my PNL and a lot of others making 6 figures to 7 figures from trading options with small account, but you don't know where to start. I have got you covered in this video because I know when you search about options on YouTube or any other social media, you get bombarded with Greeks like theta, delta, gamma, and all this sounds like language used in Asgard, but believe me, it's way simpler than that. You know me, I like to kiss. Keep it simple, smarty pants. And that is the reason in this video, I will break down exactly how beginners can start day trading options profitably step by step. This is the exact way I personally trade options, keeping it simple as that's how you make money in the market. And if you are new, my name is Jay. I'm a full-time day trader. I started in 2019, so I have been trading for 6 years now because I value your time and I value my time. So if you are watching this video, I want you guys to know that this is coming from a trader who has been consistently profitable trading options. But it wasn't always like that. I started just like you. I lost money, I made mistakes, but then I figured out a strategy that actually works, and then options gave me the leverage I needed to grow my small 3K account with proof. I recently made a video showing you guys my broker statement with 100K profit with just a 30K account in 30 trading days. Yes, I know if you're a beginner, 30K sounds a lot, but divide both the numbers by 10. So you could have made 10K with a 3K account in 30 trading days, which is more than your average 9 to 5 salary. Now that sounds a lot more achievable, especially if you're a beginner trader. So yeah, if you want more proof, I will link that video in the description box below. Again, in that video, I showed you guys Interactive Broker Statement, which is a US regulated broker. You can't fake your numbers on it, unlike the online gambling prop trading industry. So let's first start with what are options. So think of options as bets on stock movements without owning the stock. You don't own the player, you're betting on the player winning or losing. You can profit whether the market moves up, you can buy calls, or when the market moves down, you can buy puts, but you just gotta be right about the direction. Again, similar to betting, if you're wrong, you lose money, and if you're right, you might make a lot more money than you lose the risk you put in. And now the most important question is why to trade options instead of stocks? And the simple answer is leverage. Especially when you have a small account, it's difficult to make a living from trading stocks. Like if you trade shares and the stock moves 2%, you actually make 2% of your investment, and that too if you catch the extremes of the move like high of the day and low of the day, which is very difficult to do. But when it comes to options, you might actually make 50% of your investment if the stock moves 2%. Now this 50% is not like a setting stone, but it varies from stock to stock and the move you catch and the momentum or many different things, and that's the point of this video. But this just gives you an idea how you can leverage stocks using options. Now leverage is a double-edged sword because you can make 50%, but you can also lose 20 to 30%, and in case of options you can also lose 100% of your investment, especially if you trade like a degen. But if you know what you are doing, you can make good amount of money from trading options by risking less money than that, and that is the exact reason my recommendation is to start with stocks and then move over to options when you know what you are doing. That's what I did personally. I traded stocks for the first 10 months of my trading journey, and then I moved over to options once I knew how the market moves and once I had a strategy in place. And also it's not only about strategy, but as a rookie, as a beginner, you make a lot of other mistakes like order error, hotkey errors, trading the wrong stock by mistake. Yes, I have done that multiple times. So it's better to make these mistakes when trading shares, as with options you will just lose more money. It's like tuition fees. You can either pay 1% of your tuition to learn something, or you can pay 50%. Up to you. I'm not a financial advisor, but I'm sharing my journey and what worked for me to change this hobby into a living. Now, why did I mention at the beginning of the video that I'm gonna kiss in this video? Keep it simple, smarty pants. Is because I want you guys to understand how the option premiums move. I won't bombard you with unnecessary information, but once you understand the underlying thesis behind why and how the option premiums move, that's it. It's simple. Yes, there are many different strategies like straddles, strangles, which are still easy, but there are a few difficult ones, and my favorite one is the Iron Condor, which sounds like a UFC fight, but in this video I will just tell you how I trade options. So yeah, all the option Greek gurus, chill out. This is my channel and this is how I trade options profitably, which is very important. Now when you bet on options, you're actually betting on both the price and time. It's similar to you betting on a player to win by maybe say next week. So there's a time component as well. Let's take an example of Apple, which everyone knows Apple. If you think that Apple is gonna go up, you buy calls, and if you think that the Apple stock is gonna go down, you buy puts. Simple as that. So now that means there are two types of option contracts, calls and puts. To own these contracts, you pay something called the premium. Now the value of this premium changes based on if your bet is working in your favor or not. So you actually trade these premiums. So that means if you buy calls contracts, you pay a premium for it. Say for example, you paid like $300 or something like that. Now, if the stock goes up, the premiums might change from $300 to $500. That means $200 is your profit. Whereas if you buy calls and the Apple price goes down, that means it's a red trade. You can cut your loser, say for example, for $200. That means you are risking $100 to make $200, and that's how the premiums move. You are not trading Apple stock, you are trading the calls or the puts contracts, and you are trying to flip the premiums on these contracts. Now, as I mentioned, you are betting on both price and time. Here, the price component is called the strike price and the time component is called the theta, which is one of the Greeks. There are other components as well, but for the sake of KISS, keep it simple, smarty pants. I don't personally care about the other components. Now, the strike price of an option is the set price at which you can buy for a call option or sell for a put option the underlying stock. So it gives you the right, but again, you don't have to worry about that because you will be flipping these contracts. You will be flipping the premiums on these contracts. You won't hold these contracts to expiry. So that means if the stock price goes up and you're holding calls, the option premiums gain value, making it potentially profitable. Same thing happens for downside. You bought puts and the stock price drops as well. That means the premiums will gain value and you can sell the premiums, you can flip the premiums for a higher price. So this is similar to flipping house, real estate, cars, but at a much lower time frame. That's the first step. The second step is to select which contracts to buy, which strike prices. So as a rule of thumb, if you're trading Apple and Apple is holding at $200, which is the current price, stay in between plus minus 3 strike prices. So for example, if Apple is at 200 and if you think it's going to go up, stay in between 205. So you can buy 202.5 calls, or you can buy 205 calls, or you can even buy 200 calls. Now, if you think that the stock price is going to go down, you can buy 197.5 puts, or you can buy 195 puts. And there's one more thing you guys need to understand, which is at the money, in the money, and out the money. So it varies from calls or puts. So for example, if Apple is trading at $200, that means 200 calls or 200 puts, doesn't matter. It's going to be called at the money because Apple is trading at 200 and you are buying or selling 200 calls or 200 puts. Now the thing is, for calls, I'm going to talk about calls at the top and talk about puts at the bottom. So now if you're buying these calls 202.5 and 205, which is higher than the current price, these are going to be out the money contracts because you think Apple price is going to go up. At the moment it's at $200, but you think it's going to go up. That's why these are out the money. And the opposite contracts, 195 and 197.5 calls, are going to be in the money because Apple is already trading above these 195 and 197.5 contracts. And now the opposite applies to puts, because when you are trading puts, you are betting that the stock price is going to go down. That's why these contracts, which are lower than the current price, are going to be out the money. And these contracts, 202.5 and 205 puts, are going to be in the money. Why? Because Apple is already trading under 202.5 and 205 puts. So you guys need to just understand this nomenclature, because a lot of people talk about out the money contracts and in the money contracts. And personally, I trade plus minus 3 strike prices out the money. So for example, if I think that the stock price is going to go up, I'm going to most likely buy 202.5 or 205 calls. And if I think that the stock price is going to go down, I'm going to most likely buy 195 puts or 197.5 puts. So that means I stay in between plus minus 3 strike prices out the money contracts. And I understand if you guys are watching this video for the very first time, calls and puts, it's a bit difficult to understand, because I remember when I first started learning about options, understanding calls, puts, strike prices was a bit difficult for me. But if you guys just watch this video multiple times, and specifically this section of this video 2 or 3 times, you guys will be able to get hold of it. Also, one more amazing thing about options is that 69.7% of the viewers of this channel are not subscribed to this channel, which means the channel should be at 100,000 subscribers. Why are you not subscribing? This is the best day trading channel on YouTube, and it will only keep on getting better. Especially this year, we have a lot more videos planned for you guys. So make sure that you guys subscribe to this channel, because it also motivates me to keep pumping out amazing videos for you guys, and also to keep sharing my journey, because this channel is my journey. First video on this channel was how I made $90 from trading to now making 20-30K in a day. So we talked about the price component, and now comes the time component. So as a rule of thumb, from Monday to Thursday, you should trade the weekly expiry contract. And on Friday, you should trade the next week expiry contracts. For now, let's keep Friday aside, but from Monday to Thursday, on Monday, you can go a bit more out the money, but on Thursday, you need to go a bit more closer to the money. And if you guys ask me why, the answer is because you have more time on Monday compared to Thursday if you're trading the weekly expiry contracts. That means you're giving your bet more time to work out. You have to maintain this balance between the strike price and the time. So what do I mean by balance? For example, if you're buying 205 calls, you are saying meaning that I believe Apple will be at 205 by Friday because you're trading the weekly expiry contracts which expire on Friday unless it's a public holiday. Exceptions will always be there. The chances of Apple going to 205 by Friday are a lot higher on Monday compared to Thursday. But same, it's Thursday and you're taking 205 calls. It's high risk and high reward because chances of Apple going from 200 to 205 in 2 days are pretty slim compared to trading the same contracts on a Monday. So your risk is high, but if it actually makes a nice momentum move towards 205, your reward is also going to be much higher. So that means in options, higher the risk, higher the reward, lower the risk, lower the reward. But sometimes the risk is so high that these contracts are not worth trading. For example, on a weekly expiry contracts, if Apple is trading at 200 and you buy 220 calls, these are kind of lotto plays. You are going to a casino, you're expecting to hit a jackpot. If that happens, good luck, but it might not happen. The chances of that play happening is only 1%. So that means if you know how to trade option, that is the exact beauty of options. You can select how aggressive you want to be with the setup. Now remember, I mentioned that you don't have to worry about Greeks because once you understand this underlying reason why the option premiums move, you will be able to make money because it's similar to betting. If you bet on the underdog and if that underdog wins, you make bank, sometimes like 500%. But if you bet safe, if you bet on the prior champion winning the game again, you might just make 10% profit. Same thing applies to option premiums. And that is why I mentioned that leverage is always a double-edged sword, and especially with options, you can lose your whole investment as well. And that's why option trading is not for degenerate traders. You guys need to understand how much risk you are putting in and cut your loser, because if you are a trader who has an issue of cutting your loser, with stocks, you might lose like 3% instead of 2%. In options, you might lose your whole investment. And that is why my recommendation is to stay closer to the money as the end of the week approaches. But earlier on, you can trade a bit more further out the money contracts, but you just have to maintain a balance between the strike price and time. Now, coming back to Friday, why to trade the next week expiry contracts on Friday? Because when you are trading the same day expiry contracts on Friday, these are called the 0 DTE contracts, 0 day to expiry contracts. And these contracts are very volatile, guys, like similar to betting on a team to win towards the end of the game. The odds change by every second, so the premiums are extremely volatile. And as a beginner trader, you don't want that. You don't want huge swings without having a proper strategy. So trade next week expiry contracts on a Friday. Thank me later, because they are going to be very less volatile compared to 0 day to expiry. Once you get experienced, yes, you can trade the same day expiry. So for me, if I just purely want a scalper move, I might trade the same day expiry 0 DTE contracts. But if I want to hold my positions a bit longer, I will go for next week expiry contracts. And the reason is that holding through consolidation on the same day 0 DTE contracts, you're losing a lot more money because the time component. The expiry is approaching so quickly that consolidation means that the time component of the bet is going against you and the premiums are going to lose a lot of value. And that is how you kiss. Keep it simple, smarty pants, when trading options. Instead of thinking in terms of Greeks like delta, gamma, theta, start thinking in terms of betting. Instead of thinking about theta on Friday, think about betting on a team to win towards the end of the game, and it's going to be very volatile. And that's why on Friday, stay away from the same day expiry contracts. And this mindset will help you keep option trading very simple and honestly a lot more fun. Now, the other thing you want to consider, which is very important, is that as an options trader, you have to stick with liquid stocks like Tesla, Nvidia, Apple, Amazon, Meta, Google, and all these stocks, because sometimes illiquid stocks like App, Snow, LLY will have earnings, might have good price action, but the options are very spready. That means the spread between the bid and ask when you buy the contracts is very big. That means your risk is very high. And that is why with options trading, you don't have a lot of leverage to just trade random stocks. You have to stick with the liquid stocks like the big names of the stock market. Also, if a stock has earnings, the premiums go up in value. That means instead of paying $300 for 205 calls on Apple, you might have to pay $400. That means you are paying more for the bet because the chances of the stock making a big move is higher because of the earnings. A lot of times after earnings, we see a big gap up or a big gap down, and that's why the premiums are expensive. Other bookworm traders will be like IV is high, which is called the implied volatility. If you understand the name, implied volatility, that means market makers are expecting the stock to move big in either direction, and that's why the premiums are high. That's why just instead of worrying about the names like theta, gamma, delta, IV, and all these kind of different Asgard names, think about why the option premiums move and why they are expensive, why they are cheap, why on Friday they are so volatile. Because if you understand the meaning of why, it's similar to betting. So now you have understood why and how the option premiums move. Now comes the strategy part, how to actually make money using options as a tool to leverage your money. For that, I made a video already, my 100k strategy, which is what I call the market DNA. So make sure that you guys watch this video. After this video, I'm going to link it at the end of this video and in the description box below. And also, if you're a beginner trader, go on to my channel, click on the playlist and check out all the videos from the beginner series. It's going to help you a lot with your trading journey. And if you want my playbook template, which might help you with your own strategy, the link will be in the description box below. You just have to fill out a form and we will send out the template to you guys for free, no questions asked. Now finally comes the risk management part, because now you know how and why the option premiums move. You have a strategy in place after watching that video. Now comes the risk management part, because this is the most complicated part about options trading. Your risk varies from stock to stock, which strike price you trade, which expiry contracts you are trading, etc. But the thing is that if you trade the same bunch of names like Tesla, Nvidia, Meta, Microsoft, Amazon, you get an idea. For me, I know my risk is like 10% if I'm trading Tesla and Nvidia on an average. If I'm trading Meta, it's more like 20-25%. On Microsoft, it might be 15%, also depending on the day. On Monday, my risk will be on the lower side compared to a Thursday if I'm trading the weekly expiry contracts. And the thing is that it only gets better with time and experience. The more you trade options, the better you get in predicting the risk. That's why start with stocks, then move over to options with 1 or 2 contracts, as trust me, your intuition on how much risk you are putting in on a trade, depending on the stock, will only keep on getting better with time and experience. If you guys want to see how I trade options and how I manage my risk, I have plenty of videos on this channel. Simply click on playlist on my channel and check out the trade breakdowns playlist. I have plenty of videos in there. Also, if you guys don't know, the time component of me making this videos is approximately 20 hours. It approximately takes me 20 hours to plan a video, record the video, edit the video, thumbnail and everything. So I would really appreciate a thumbs up if you guys like this video. Subscribe to my channel if you are new. Thank you for watching and I will see you guys in the next one. Before you go, don't forget to follow me on Instagram. I post a lot of good free day trading content on Instagram as well. The link will be in the description box below.